Hello and welcome to our Real Estate Investor Workshop, whether this is your first time joining us or if you have attended other sessions. My name is Michael Matthew and I've been a professional accountant for more than 30 years. My international practice is focused on real estate and real estate investors. I'm also the CFO for a home builder. Services I provide include entity structuring, setting up in both Canada and the US, operational and tax consulting, and tax return preparation for both Canada and the US. I'm also a real estate investor. I own a nearby condo in the Toronto area, and I'm looking for small apartments in the US, initially starting with Texas. The plans for the group are to meet on the last Thursday of the month, subject to change around holidays, at 7 p.m., and I deliver the content along with guest speakers. We will address various issues related to real estate investing, including additional considerations for investors with U.S. properties, like we're looking at tonight, taxes, and accessing other allied professionals, financing, types of real estate investment, and so on. Now, to keep my lawyer happy, I'll just show you briefly our disclaimer here. Essentially, all this comes down to is this is meant to be information and not actual tax or legal advice. If you have any questions during the presentation, please go ahead and raise your hand using the reactions button, or just unmute yourself and ask your question. If you have more detailed questions or something you'd like to discuss one-on-one, please arrange a free 15-minute session by emailing me at the address michael@askmichael.ca to arrange a mutually convenient time for us to speak. And that address has also been put in the chat for you. So we're going to get started now with our topic for tonight, financing options for Canadians investing in the U.S. We're going to cover a number of topics, including cash, seller financing, subject to, limited partnerships, joint ventures, and various types of lenders. So obviously the easiest one, most straightforward one to understand is cash, and this involves you taking cash and investing that in the US. You may not have cash readily available, so the most straightforward place to get that is from what's called a HELOC, or home equity line of credit. And all that is, it's a line of credit secured by the equity in your home. So let's say you have a home that's worth $500,000 and you have equity of $200,000 on that. In other words, your mortgage is $300,000, then you could borrow against that $200,000 differential. While you could also get a second mortgage on your property that is a bit more restrictive in that it's for a fixed term and so on, and there's always some sort of prepayment penalty, whereas with the home equity line of credit, you're going to pay slightly more in interest, but you will also have the ability to pay it off at any time without any penalty. So it just gives you all the flexibility as your investments come in and go out to access the cash and return it through that function. You can also use registered US funds. Now that's the difference here to note. In Canada, you can only use registered funds to invest in a mortgage, but by partnering with someone in the US, you can access their registered funds, because while many people don't have liquid cash available for financing purposes, they do have money sitting in a retirement account that may be getting little or in fact negative return. So just in terms of terminology, they have a self-directed IRA, which is similar to our self-directed RRSP, a Roth IRA, which is similar to our TFSA, and a 401k, which is similar to Canadian Group Retirement Savings Plan. So by partnering with a American resident that has any of these plans available, funds in those plans, you're able to invest through that mechanism. The next one is seller financing. Seller financing has a lot of other names, as you can see here. It's often known as vendor take-back, vendor financing, vendor buyback, and so on. And this is something that whenever you invest in real estate, you should always ask the vendor if they're interested in doing this. And why would you do that? Well, from your perspective, you have less money out of pocket, because let's say you're buying a property again for $500,000, and by getting a vendor take back of, let's say, $200,000, you only have to give the seller $300,000 now, and you pay the remaining $200,000 over time. So you have no loans to qualify for. It's just whatever you negotiate with the seller. It adds value to the homeowners because they'll have advantages as well, and it allows you to increase your portfolio much faster because you're not limited by the amount of funds that you personally have access to. You'll never run out of sellers who have the ability to accept this seller financing. And why would they want to do that? It allows them to reduce their capital gains, because instead of recognizing the gain all in 1 year, if you bought the property outright with the first and only payment, by paying over time, then they recognize the gain over time. It also serves as a source of cash flow. So for someone that would like to have money coming in every month but don't want to deal with tenants anymore, then they're getting an interest income payment instead. And this also allows them to sell for a higher price. So you may not want to pay them the full price that they're asking for right now, but you're willing to do it over time because you don't have to come up with all the money at once. So it can be a mutually advantageous situation. So when you're doing this type of negotiation, you need to bear in mind you have to find out what is the most important consideration for the seller and work that into your offer, because if you present something that doesn't meet their goals, it's obviously not going to be a successful offer. You have the ability to negotiate all these terms. So the purchase price, like we mentioned, the longer you have to pay it, the more you can afford to pay. The interest rate, and sometimes you can increase the interest rate so the price stays the same, or you keep the interest rate at a lower rate and increase the purchase price like we talked about. So there's flexibility in a number of different areas. Amortization length, and this just means how long it's going to take you to pay the vendor out. Depending on the property, it's usually going to be anywhere from 1 to 5 years. And find out how much of a down payment they need. Perhaps they need to cover their own moving expenses and first and last if they're going to be renting, that sort of thing. And then the size of the balloon payment. And that balloon payment is just the amount that's left over at the end of that amortization term. In other words, how much you still owe the vendor at that time. Next thing we're going to talk about is subject to. This is also known in Canada as agreement for sale. So it gets its name from the transaction being subject to the original mortgage staying in place. So in the US, you actually take title and take over the mortgage. Some of you may be aware that it's a standard term in every mortgage, essentially, that there's a due on sale clause, meaning that when the property is sold, the bank has to be paid out for the amount of the mortgage. While theoretically that is possible for that to happen, based on my discussions with real estate investors who've been doing this for decades, no bank has ever enforced that clause because banks don't want to own properties. They just want to lend on them. So they're just happy someone is making the mortgage payments. They don't really care exactly where it's coming from. When you engaging in the subject to model, you're going to want to have a schedule of the payments to the so the owner understands how they're going to be made, and the mortgage pay down is credited to you on closing, so that needs to be documented. Like everything else in real estate, you want to make sure all the key details at least are written down. I'm going to talk about limited partnerships, but if there's any questions at this time, please stick your virtual hand up or just unmute yourself.
Sorry, I had a question.
Sure.
So, based on that previous slide, does that mean like when the seller sells the property the seller sells the property to the buyer takes the original mortgage and mortgage payment?
That's right. Yeah. So it actually raises a good point. So I'm glad you asked that question. I can't see the names. Who's asking?
My name's Chat.
Chat. All right. Thanks, Chat. In the States, unlike in Canada, when they have a 30-year mortgage, it lasts for 30 years. In Canada, we can have a 30-year amortization, but as anyone who has a mortgage knows, you're going to have to renegotiate that mortgage essentially every 5 years in most cases, or less. So you're stepping into the shoes, is what it's called, and making payments according to the terms of that original mortgage. So whatever the terms are, the date they have to be paid in the month, the amount, and so on, all that's dictated. You're not renegotiating this mortgage, you're just taking up the payments. And I sort of wondered how this is done, and it's often done through a joint account with the name of the buyer and the name of the seller on it, so both of you have access, so both parties know that the payments are being made, and it's just the buyer is the one putting the money into this account, and the bank takes it out as if the original buyer, which now the seller, is making the payments, and everyone's happy.
How does that work when the house transitions to multiple owners? Is it that same joint account, or?
Oh, you mean if there were multiple buyers? Is that what you mean?
No, say like one person bought the property and then sold it in 2 years, and then another person bought it next 2 years. How does that joint account work?
I guess theoretically that's possible, but what you would do is, as I understand it, you would just drop off the person who's no longer involved, because there'd be no point in having them anywhere on the documentation. You'd have to, as I understand it, you'd have to have the original property owner's name on the account, and then who's ever making the payments, and that's just so that they can have access to the account.
Okay.
Okay. Anyone else with a question?
I have a question. The name is Danique. I'm still not understanding. Is that what happens in all cases or most cases, when you have a traditional type of transaction between a buyer and a seller?
No.
Or is that
No,
okay.
not at all. This is only in the subject to, and the subject to is someone, they can't afford their payments, right? That's why they want to do this type of deal. But if they default on the mortgage payments, then that goes on their credit record And obviously that makes their life more difficult for the next 5, 7, maybe even 10 years. So that's why they just want it to not negatively affect their credit rating. And so that's why they do that. If it's just a traditional sale, then you are paying the seller the amount that they've asked for, and before they get paid any amount directly, the mortgage is paid out. And then if you need to, you would put your own new mortgage on the property.
Okay, so when do you typically see that subject to happening? Like, is that usually between like maybe two family members? Because I don't understand how the title would work in that. Like, when does the title transfer since
Well,
the seller still kind of has access or some ties to it?
yeah,
And
well, what's different here is the mortgage is separated from the property ownership, right? So in the case that we're talking about here, the subject to, the buyer is taking over the ownership and they're making the mortgage payments, but the mortgage is still continuing, the original mortgage. That's what's different about it. In the traditional case that most of us are familiar with, the old mortgage is paid out and a new mortgage is put on the property by the buyer.
okay, so the mortgage wouldn't be tied to the original homeowner?
No, at that point, their mortgage will be paid out. So that's, yeah.
I'm referring to the subject to situation.
Yeah, oh, and the subject to, yeah, the original mortgage continues.
So is the original owner still responsible or accountable for having that mortgage paid, or is
Yes,
it
yeah,
transferred as well?
yes, they are, and that's why they're doing this, because they can't afford to make the payments. And it's a situation where there isn't a huge amount of equity in the property either. Because if there was a huge amount of equity, they would just sell it, pay off the mortgage, and put money in their pocket. But what we're talking about here is a case where the mortgage is potentially worth more than the property. And
Okay. So would the bank have to give approval? Because I'm still not clear on whether or not the title is actually transferred.
yeah,
I know you said it's separate, but
title is transferred, the mortgage is not. That's the difference.
okay,
The two
okay,
documents are split.
got it.
It works differently in Canada, but since we're just talking about US properties in this case, yeah, the title actually transfers. So if someone was to look up the ownership of the property after you executed this deal, they would see your name on the ownership.
So this would only benefit if they can no longer make the monthly payments.
That's
They're
right. Yeah,
trying to get rid of the property.
that's
Yeah.
right. Yeah, because if they just walk away, then the bank is left holding the bag, so to speak, and they'll go after them. And obviously they can't pay, and they've fallen behind. Like, these are not people who are, a week late. Right? We're talking people who are typically 4 to 6 months late in their payments. And in order to preserve their credit rating, then they would be open to considering such a deal. And often you will not only catch up the arrears, right? So you'll pay that 4 to 6 months of payments. You will also give the seller, maybe they need $5,000 to move and put down, say, a first and last on a rental unit. Then you would be giving them cash for that.
Okay, what's the advantage of the buyer doing this kind of?
Oh, good question. The advantage is simply this: you don't have to qualify for a mortgage,
Oh, okay.
right? The mortgage is already done. You just step into the role of the person making the payments. So you could own 2, 5, 10 properties this way. There's no limit because nothing's getting registered against your credit, right? As long as you're making the payments, everyone's happy. The previous owner is happy because their credit rating is preserved. The bank is happy because they're getting their payments. And again, they don't want to take over the property. That's the last resort that they undertake because they're not in the property management business. They're in the collecting interest and principal payments business. All right, anything else?
Yeah, so is there a risk to the seller that's still kind of tied to the mortgage but not on title anymore?
Yeah, there is a risk, but the buyer would be foolish not to keep up those payments because they're getting a property worth whatever it's worth for perhaps, I don't know, 10, 15, 20,000, right? They could get a property that's worth 200,000. So why would they not want to keep that up? They have much more to lose typically than the vendor would have.
Okay.
And if you want to get really tricky, you could combine these two financing methods. You could take over the mortgage for part of it, and the vendor could also do a take back. So it really depends on how much equity is in the property. That's really the starting point. And unlike in Canada, all this information is public. You can get a copy of their mortgage and a copy of their deed online in most states. At least the investor-friendly states, you can get that. It's all considered public information. And it's often available at no cost or minimal cost. So you can access the information you need that way.
Okay.
Okay, so we'll go on to the next. I'm going to talk about limited partnerships, but in order to do that, I need to briefly talk about what a general partnership is. When people talk about partnerships, they're implicitly talking about general partnership. And with a general partnership, all the partners are equally liable for any debts of the partnership. So one party can make a deal and they automatically bind all the other partners in that particular partnership. Your income is taxed at whatever the partner's individual income tax rate is, or if they happen to be a corporation, because they can be partners as well, at the relevant corporate rate. The big difference between the general partnership and the one we're about to talk about, limited, is how the liability issue works. With a limited partnership, that consists of typically one general partner, although you can have more than one, and one or more limited partners. And they're called limited partners because they, as a limited partner, their liability is limited to the amount they contribute to the partnership. So let's say that they put in $50,000 and there's a issue with the property and perhaps someone slipped and fell and sued and they wanted $100,000. Well, that partner could only lose the $50,000 because their liability is limited, hence the name, limited partnership. So you will have this general partner. It's always a corporation to limit the liability to the corporation itself. And you can have the sole shareholder, who's the party arranging the real estate deal, if it's as that type scenario, they'll be the general partner in terms of controlling that corporation. And this is what I just mentioned earlier. As long as you limit your involvement, you have that liability shield. And why would you want to do this? Well, the limited partners are often people as individuals. If you're an individual and you have a liability issue, then all your personal assets, so your house, your car, any investments you have, all of those are at risk. And by having this limited partnership structure, you can't lose any more than you've already put in. And that's why it's a very appealing structure. As with any sort of partnership or shareholder situation, you need to have an agreement, and that sets out all the duties of the various parties. And essentially, the general partner does everything except for major decisions such as involving the sale of all the assets of the business and the buyout or withdrawal of a limited partner. Other than that, the general partner does everything. One of the advantages of this is privacy of ownership. Only the limited partnership's name will appear on title, and this applies to both Canadian and US partnerships. You have what's called pass-through treatment. So if you're an individual limited partner, as I mentioned is often the case, you're taxed at your individual tax rate. So unless you're at the top tax rate, you're going to be saving some money in almost all cases that way. Because this is a limited partnership, there are additional costs. You have to register your limited partnership. Contrast with general partnerships who don't have to be registered anywhere. You do have to register your limited partnership in the jurisdiction that you're operating. And it's often used for rental properties where you're raising funds from multiple parties, and you can use the structure for any business, but it's very common in real estate. And as I mentioned earlier, this limited partnership structure works in a similar fashion in both Canada and the US, which makes it easier to comply with the securities legislation in both those jurisdictions. The next one is joint venture. A joint venture is two or more parties joining forces to carry out a specific project, and they split the revenue and expenses in accordance with a predetermined formula, and each has some control of the project. Now, it's interesting to note that you can have unequal contributions of assets, but equal splits of the income. So perhaps one joint venture is doing most of the work, and so they may only contribute, say, 30% of the funds, and the other joint venture is essentially just writing a check, but they've agreed to split the income from the joint venture 50-50, or whatever percentage you agree to. Many people think if there's two people in a joint venture, then both parties automatically get 50% of the income. That's not the case. It's just whatever you agree to. Each joint venture retains title to their property being contributed to the joint venture, and you have the same limitation of liability issues and income tax issues as a general partnership. So what that means is one joint venturer is responsible for all the debts of the joint venture. And again, you're going to want to put this in writing to specify exactly who does what, and you need to cover the various exit strategies, buyout provisions, dispute resolutions, and so on. And it works best for a one-off transaction because it doesn't continue past the selling off of the property, however that is done. Any questions at this point? Okay.
I have a question.
Oh, go ahead.
Nick, you mentioned having to register when you do a limited liability versus a general.
A limited partnership, that's right.
A limited partnership. Is that the case in Canada or it's just yours?
Yes, it is the case in Canada. You have to register a limited partnership. If you and I go to business as in a general partnership, that's registered in our office desk drawers. That's the only place it shows up. No one else, there's no document that has to be filed anywhere. But the limited partnership has to be registered, and that's because you're getting that special protection as a limited partner where you're saying, hey, you can't come after me for anything beyond what I've already put into the company. Into the partnership, I should say.
So any partnership, why would anyone not do a limited versus a general if a general puts you at such great risk?
Good question. Some people actually want to run the business. They just don't want to cut a check. And if you want to be involved in the management of the business, you cannot be a limited partner, because that's where it gets very dangerous. As I said, most limited partners are individuals, although that's not a requirement. You can be a corporation that's a limited partner. And the way it works is that you're not allowed as a limited partner to get involved in the management of the business. So decide how it's run, what to do, and so on. You're just not allowed to. And if you as a limited partner do that, you're actually giving up your limited liability status. And since, as I mentioned, most often you're an individual, then again, all your personal assets are exposed. And you do have to go through the formalities of registering. It's not a huge fee or anything. It's usually a few $100s, but there's additional paperwork. There's often an annual return that has to be filed. So your taxes are a bit more complicated and that sort of thing.
So since you're not able to be involved in kind of like the day-to-day decisions or whatever, does that mean you have to set up like a board or a management team or something like that for that type of?
In a way, that's what the general partner does. So you're going to have a corporation as the general partner because they're going to take all the liability. So just to flesh this out a bit, they're going to have all the liability essentially, but they may literally get 1% of the income from the limited partnership, just enough to cover their costs and make a small amount of money. Literally 99% of the income is often paid out to the limited partners. But it's the general partner that makes those day-to-day decisions that you mentioned.
Okay.
Okay. And again, all that is specified in your partnership agreement. So we're going to turn now to private lenders. Just want to distinguish among several types. You have mom and pop lenders, hard money lenders, and institutional private capital, which are somewhere between these two categories. The number one thing with a private lender is you need to establish trust, because what they want to know is you're not going to run off with my money, you're not going to lose my money, and you're going to make me money, in that order. That is their biggest level of concern. So with the mom and pop lenders, these are people who perhaps have investments in some of those registered funds we talked about earlier, the 401k, the Roth IRA, and the regular IRA. And they may be getting very little return. Depending on what they're invested in, it could be negative. So they're not looking for a huge interest rate. They just want something that's reliable. So you can often, prior to the recent round of interest rate hikes, if you were offering them 6 or 8% return, many of them would have been thrilled with that because they were lucky to make 2% in what they were invested in to begin with. Then you have a hard money lender. These are professional lenders, and they're going to be charging higher interest rates and fees. So double-digit interest rates are quite common for these types of lenders. And these are best suited for short-term projects or as a stopgap measure. So if you're doing a fix and flip where you're buying a property that's a little bit run down, and then you're going to be fixing it up and reselling it, hopefully within 6 months or less, at a much, much higher price, then it actually can make a lot of sense to pay 10, 12, 14% per year interest rate, because you're not going to have the money borrowed for all that long. And if you can generate $30,000, $40,000, $50,000 return on your investment after paying those interest rates, I mean, I do that deal all day long if I could find such a situation. So people often get scared off. Oh, I don't want to pay that high an interest rate. Well, you're not going to be paying it for 30 years. This is not who you go to for that. Another situation would be where perhaps it's a larger project, maybe a small apartment building, and it's going to take you a year to fix up the various units. Maybe there's a couple vacant right now that you can really renovate to a high degree, and then you'll have some turnover and just generally fix the place up. In a year's time, you could take a building that a traditional lender, a bank, would not really be interested in, and now make it an attractive investment for them. And when you do that, then you'll drop your cost of capital from those double-digit interest rates to something that's much more reasonable. So don't think that they can't help you if it's a short-term scenario. There's also what's called institutional private capital. As I said, it's somewhere between the two. And I'm going to show you a couple names here, and these are for illustration purposes only, but just because I've heard as an investor myself that these are out there, but I had no idea what kind of rates are we talking about. So when I looked at this program here, it was interest-only payments, and it's suitable for the fix and flips like I just talked about, or the bridge loan, which is that short-term loan while you fix a place up so you can get it financed by a more traditional lender. So it's 1 to 2 years basically, and the rate started at 6.99% as you see, and they also have a lender fee, and that's with these non-traditional lenders, if I can put it that way. There's almost always some kind of fee, which is a percentage of the amount that's being borrowed, and they take that right off the top. So if they're lending you $100,000 and they're taking a 1% fee, then they're going to take that 1,000 off the stack and you're only actually going to get 99,000. So that's how it works. And then you'll pay an interest rate, as I said, in this case, anywhere from 7.5 to, let's say, 9%, and you don't need a credit score. So that obviously is very useful for Canadians, because you could have the best credit possible in Canada, which I believe is... Oh, George, are you still seeing the presentation?
Yes.
Okay, because someone said that it froze. Okay. And yes, if the technology gods favor us, this will be posted so you can watch the replay. Yeah, so I was just saying that you can have the best credit rating possible in Canada, which I believe is 900 score. But if you have no U.S. assets and no U.S. credit history, you're going to have a score of 0 in the States. So this is where a program like this could be quite useful. They also have rental programs covering 5 to 10-year loans, and they have a minimum requirement about how much income has to be generated. But this particular type of loan requires you to have a U.S. credit history. Their minimum score is 610, that's pretty low. So if you do have a U.S. credit score, chances are you're going to be well above that figure. Now also online lenders, one in particular I'm aware of called Lendi, and they finance both long-term rentals and short-term rentals. And short-term rentals, if you're not familiar with the term, that covers things like Airbnb and VRBO. I believe it's all acronyms, but I believe that's the correct one. And just to give you an idea of what they cover, they'll do anything from a single-family home up to an 8-unit apartment building and up to $2 million. And what's interesting about this particular company, they only work with foreign nationals. So as a U.S. resident, you cannot borrow from them. They're literally set up to help Canadians and people from other countries around the world invest in the U.S. So, by way of summary, we have numerous financing options available to Canadians looking to invest in the U.S. Some options are better suited to certain types of investing than others, like we just saw, and do expect to pay a higher interest rate than an American borrower. And just the last thing to mention is, when I was talking about the joint venture, I specifically had in mind where you would joint venture with an American resident. So you could bring down the down payment and some renovation money, let's say, but because they're a resident and they have a U.S. credit score, they can then qualify for a loan and get the mortgage in place for you. So that's a specific way to get the joint venture to work. Our next event will be August 31st, again at 7 p.m., and we'll announce the topic later on. So at this point, please ask any remaining questions.
I know you talked about the HELOC earlier on. I'm guessing most or many Canadians use their HELOC to buy a home straight out cash.
That's right.
Besides doing that, you mentioned the company Lendi.
Mm-hmm.
If you don't have the cash, I'm guessing your other best option, and you don't know a U.S. resident, would be to seek out companies, because I'm guessing maybe there's more than just Lendi.
That's right. That's right.
That product.
Yeah.
Foreigners.
Yeah. If you are interested in Lendi or any others, just please send me an email. George, maybe you could just, I think it's already in the chat, but just michael@askmichael.ca, and I could pass that along. But yes, I put those names in there just to illustrate the concept. because again, I hear, oh, there's these companies. Well, name one. Well, here I have, and there are other ones out there, and yes, they're a good option for Canadians because they're set up mainly, or in the case of Linda, exclusively to work with foreign investors. So typically they are set up to do things online. And certainly Lenda, I know for a fact that's how they do things. It's all done online. You don't have to, drive anywhere and so on. And they've worked out how you provide the ID and everything like that through the online process. But yes, you would look through those. You can also do a joint venture with another Canadian who does have those connections in the US and get into it that way. You can also look to participate in a limited partnership where someone else is doing all that legwork, right? That's what the general partner is doing. And we didn't talk about it earlier, and it's simply because they're not doing it yet. But there are at least 2 companies I'm aware of that do what's called fractional real estate investing. And what this allows you to do is to own a small piece of a property along with many other investors. That's done through what's called the crowdfunding exemption to the securities legislation. Typically, that limits your investment to anywhere between $1,000 to $2,500 per property, but you can invest in multiple properties. They are operational in Canada right now, and they are planning to expand their model to the US. So that would be one way to participate in the types of returns that are possible when you're investing a lower dollar amount in the US, but getting equivalent or even higher returns. And that's why I'm talking about investing in the US, simply because investing in the Toronto area or the Vancouver area is very, very difficult. Not impossible, but very difficult to make money because your initial investment is so high. My co-host and I, George, were looking at some properties in Ohio, and there's 5 properties. They're small houses, but 4 of the 5 looked quite nice from the outside. The total cost, that was the asking cost, was $320,000. Now, I would not want to live in a house that cost $320,000 in Toronto, let alone having 5 of them that cost a total of $320,000. So the entry point is much, much lower in many cases in the US. And that's why it can be attractive to look to invest there. Now, obviously, as much as we have in common with our American friends, it's across a border, so there's more paperwork involved. And you are going to need professionals, but by joining groups like this and liaising with other that are investors, you're going to be able to access the people that can help you do what you need to do. And everything from having access to an attorney who can help you out to a foreign exchange trader. Right? You don't have that consideration, obviously, when you're investing in Canada, but when you start moving tens or hundreds of thousands of dollars to the US, having a foreign exchange trader contact is helpful because they don't have a business if they don't give a better rate than the bank most of the time. There'd be no reason for them to exist. And so every bit helps when you're moving that much money. Might as well save by using a trader. And yes, I do work with investors that are investing in the States. And just by way of clarity, I'm a CPA here in Canada, and I have a arrangement with US CPAs, and they do all the corporate setups. So any state that you need a corporation set up in, they'll do. And they'll also file your U.S. tax returns. And I coordinate with them and give them the information. And essentially, in most cases, what you'll get from them is a tax return to sign and a bill for you to pay directly. I don't get involved in the payments. You just pay them. But they specialize in working with real estate investors, and many of them are foreign based. So it's routine for them to do that. Okay.
So out of all the different approaches you can take, what would you say would be the best for Canadians?
I'm going to quote my lawyer, and George knows him quite well as well, Joel Mixa. It depends. It depends on your investment goals, how much money you have available, in what form it's available. Obviously, the simplest, most straightforward way to do it is, as you suggested, just get a HELOC on your Canadian real estate and go down there with all cash. It couldn't be simpler. But unless you're sitting on a significant portfolio of real estate already, you're going to be limited as to how much funding is going to be available through that mechanism. I don't care who you are. You could be, I think Elon Musk, isn't George? I think he's still the richest man. I haven't checked Tesla's stock today, so, but let's say Elon Musk is the richest man in the world. Even he runs out of money. He can't buy every real estate property in the U.S., let alone in multiple countries, with his own funds. So he has to borrow from somebody somewhere. So why not adopt that strategy from the start? Keep your funds available when you have to invest it. Maybe you have to move quickly, let's say. And in order to secure property, you've got to come up with a $50,000 down payment or you're going to lose the deal. While you can raise that fund saved from other investors, that will take some time. And so having the flexibility to quickly access your HELOC that you've already set up, all you have to do is draw upon it and then make that $50,000 payment. That'd be a good way to use the HELOC. But when you have the opportunity to raise funds in another fashion, then it may make more sense to save that HELOC for an emergency and go ahead and raise those funds through any of the other methods we talked about here.
Okay, would you say that the interest rates and the requirements for a lender like Lendi is more stringent and interest rates more higher than your traditional bank or lending institution?
They are going to be higher. There's no question about that. It's just simply the case. They're going to be higher. And that's basically supply and demand, right? Unlike in Canada, where essentially we have 5 big banks, they have thousands of banks in the US. So there's a lot more competition, and that drives down the interest rates. While there are quite a few lenders out there, non-traditional lenders, there's nowhere near as many as there are banks. And certainly not those with significant funds, right? Theoretically, everyone who has a self-directed 401k or a self-directed IRA, the individual retirement account, every one of those in the States, which is millions and millions of people, every one of those is a potential lender. But they don't have necessarily millions and millions of dollars available. So yeah, absolutely. Let me put it to you this way. If you're getting into a larger project like an apartment building, you can go into it with hard money to get the deal, and maybe you have to stabilize the rent situation traditional bank, as an example, will not typically lend to you if you have more than 10% vacancy rate. And maybe your strategy is to find buildings that are run down, fix them up, and refinance them. They're almost always going to have less than that 90% occupancy rate. Therefore, you can't borrow from a traditional lender. So that's when you get the hard money loan, that double-digit interest rate. You have a year to get the rents up by fixing up the units that are empty and renting those out, fixing up the place generally. Then you're now, let's say, at 95 or a greater percent occupancy. You can go to a traditional lender and get your property refinanced at that much lower rate. But yes,
Okay.
it's the nature of the business models. They're always going to be more expensive. It's but they're also way more flexible, right? If you have your choice, of course you want to borrow from the lowest interest charging entity. But those banks there say, well, where's your U.S. assets? I have none. So why are you talking to me, right? Companies like Lendi, they're filling that gap in the marketplace for investors that do want to invest in the U.S. but don't have the standard requirement of the U.S. assets, the U.S. credit score, the U.S. History that the traditional lenders require.
So if you go to someone like Lendi, you get a property and you have that for a while, you're building your credit. Is it easy for a Canadian after that point to
Sure.
switch?
Yeah,
Okay.
yes. Yeah, you've got your foot in the door, so to speak, at that point. Because the most difficult property to finance is the first one you have in the U.S. Once you have one property, as you just pointed out, well, now you have U.S. assets. You have a U.S. credit score, a U.S. credit history. So yeah, absolutely, it'll be much easier for the second or third or fourth property. Sure.
Thank you.
Absolutely. Any other questions? Okay, well, if you do have some questions, like to follow up with me, again, my email address is michael@askmichael.ca, and our next presentation will be in, I think it's 5 weeks. Yeah, 5 weeks, August 31st at 7 p.m. And as always, I will announce the topic a little bit later. So thanks
I
for.
do have a question.
Oh,
Are you
sure.
considering topics around property? Like you mentioned that you're looking in Ohio more on the real estate side versus just the financing side. Is that something that you're interested in talking about or no? Not really.
Are you, I'm not sure exactly what you're asking. You're saying, talking about what kind of investments to do in the U.S.? Is that as opposed to the financing aspect? Is that what you mean?
Yeah, like real estate or even if you're looking in Ohio, maybe you're looking in other places too, like good states that's easy to do business in or good
Yeah,
potential
we've
for.
talked about that in various presentations in the past. The starting point for my investment strategy, and I strongly urge you to follow the same, is the number one consideration is this an investor-friendly state? Because if it's not investor-friendly, let's say it's tenant-friendly, and you get a problem tenant, you got a problem. As an example, if you have a problem tenant in California, they can not pay you for a year before you can kick them out. In Texas, they got about 3 weeks if they haven't paid you before they can get kicked out. Huge difference. In Texas, let's say you were holding the mortgage, you would actually be able to foreclose on that property. In other words, take it away not from a tenant, but an owner in less time than would take to kick out a tenant in a state like California or New York or New Jersey. So always start with that. Is it an investor-friendly state? The next thing I suggest you look at is the population growing, and is it growing because of jobs? Many places in Florida are growing in population, but when you look at the reason why, it could be because there's a huge influx of retirees. For whatever reason, people don't want to retire where it's colder. They want to retire where it's warmer, and that covers both Canadians and Americans. So many Americans are migrating from the northern states, Michigan, New York, New Jersey, and they're moving south as well. If you have a product that's catering to seniors, perhaps you're getting involved in seniors retirement communities or a nursing home, that sort of thing, then that makes a lot of sense to invest in there. But if you're investing in more traditional housing, it may not work out as well because you're wanting to command premium rents from a population that has very fixed income. So look at number one, investor friendly. Number two, is the population growing? And number three, is it growing because of jobs? If the answer to all those is yes, it's usually a good place to invest. And that covers places like Florida, Georgia, North Carolina, South Carolina, Texas. What's booming now is Idaho, of all places, because all the Californians that are leaving the state of California. Just a quick way to judge those migration patterns is you get on the U-Haul website and look at the rental costs between two places. So it costs about 3 times as much, the last time I checked, to rent a U-Haul to go from California to Texas as to go from Texas to California. And the reason for that is if they don't make it very cheap for you to rent to drive from Texas to California, then U-Haul has to send an employee to Texas to pick up the truck or the van and drive it back, and they get zero income from that. In fact, it costs them money. So they'd much rather have someone rent it at a low rate, drive it back to California, and then they can rent that to a Californian driving to Texas at triple the rate because that's where the demand is. So that's just a quick, easy way, and it's free, right? You can just go online and you can check the rates. But that will tell you, it's one of the cues as to where the population's moving.
That's interesting.
Yeah, I thought that was a kind of a neat one myself. I guess we'll do this auction style, going once. Any more questions? Going twice. Sold. All right, so we'll call it there. Thanks for your attendance and your questions. I appreciate you being here, and I hope to see you next time. So, bye everybody.
Thank you.
Good night.
Bye.